Hey everyone, and welcome to this explainer. Today we're putting on our detective hats to solve one of the most fundamental, and frankly, most notorious mysteries in business, tracking indirect costs. If you've ever looked at a company's finances and wondered where all the money actually went behind the scenes, well, you're the exact right place. We're going to decode the complex, sometimes dry, terminology of cost accounting and transform it into a really clear, actionable investigation.
Here's our structured roadmap for the investigation today. First, the overhead cost mystery. Second, assigning costs to centers. Third, absorbing costs into products. Fourth, dealing with the differences. And finally, activity-based costing.
Okay, let's dive right into Section 1, the overhead cost mystery. So picture this. You're walking through a massive manufacturing plant. You see the raw materials, you see the workers right there on the assembly line. Those costs, they're super easy to track directly to a product. But look up for a second. Who pays for the factory roof? Who pays for the insurance, the electricity keeping the lights on, or even the wages of the supervisor who oversees the whole shebang? How do those shared costs ultimately get paid for by individual units of a product? That right there is our central mystery.
In a typical unit cost breakdown, direct materials and direct labor are really easy to spot, but that third slice, overheads, takes up a massive chunk. In fact, in some highly automated modern factories, overheads can actually make up more than 60% of total product costs. Because they aren't tied directly to one specific product, they can easily slip right under the radar. And if left unmonitored, this slice will secretly kill a company's profitability.
So, who are the primary suspects in our cost mystery? Well, they fall into three main categories. First up, indirect materials. Think of things like cleaning supplies, stationery, or the lubricating oil for the machines. Second, indirect labor. This includes the salaries of supervisors, factory maintenance workers, or even bonuses. And third, indirect expenses. Things like rent, insurance premiums, heating, and the depreciation of assets.
Just to cement the foundation of our investigation, let's formally define our target. Overheads are the aggregate of indirect materials, indirect labor, and indirect expenses that simply cannot be assigned to specific cost units. I mean, you can't say exactly how much of the supervisor's salary went into making one single wooden crate or one bottle of soda, right? It's a shared burden.
Moving right along to Section 2, assigning costs to centers.
To actually do this tracking without getting totally lost in accounting jargon, we're going to use a guiding framework I like to call the 3 A's. Allocation, apportionment, and absorption. These 3 sequential steps are how we force overheads to finally reveal themselves and attach to products. Let's look at the first 2 A's. Think of this like splitting a dinner bill with friends. Allocation is direct assignment. It's like paying for your own steak. If an overhead cost is specifically incurred by one single department, say a specific machine's depreciation in the sawing department, it is wholly allocated right there, no sharing required. But apportionment, that's figuring out how to fairly split the shared appetizers. These are costs incurred by multiple centers or the whole organization that have to be shared out using a fair and equitable basis.
Now, to share those appetizers fairly, you need a logical, physical basis. If the shared expense is something like rent or building insurance, we logically apportion it based on the floor space occupied by each department. If the expense is electricity, we divide it up based on kilowatt hours used. It's just a really systematic way to ensure everyone takes their fair share of the bill.
It does get a little bit trickier when service departments, like maintenance or HR, serve not only the production line but each other. Accountants handle these reciprocal services using some pretty complex reapportionment methods, like simultaneous equations. We are definitely not doing the complex maths today, but the core logic is absolutely vital. Service departments don't make the actual products. Therefore, all their costs must ultimately be pushed down into the production departments, because products are what generate the revenue to actually pay the bills.
Okay, let's hit Section 3, absorbing costs into products.
The primary key to cracking this whole cost allocation mystery is the overhead absorption rate, or OAR. We simply take the budgeted overheads for the period and divide them by the budgeted activity level. Why use budgets? Well, because actual overheads aren't truly known until the end of the year, and waiting until December to price your products is, frankly, a terrible business strategy. We have to use predetermined budgets to quickly estimate product costs as we go. But what exactly is an activity level? Well, it really depends on the factory. If you're investigating a highly manual, labor-intensive factory, they're logically going to use direct labor hours as their activity base to apply the OAR. But if the production process is highly mechanized with lots of robots, using labor hours makes zero sense. They'll use machine hours instead. You can also use units of production if everything made is perfectly uniform, or even percentages of material costs.
Factories have to choose between using one giant rate for the whole facility or specific rates for each department. While a company-wide blanket rate is way easier to calculate, departmental rates are highly preferred. Why? Because products consume resources so differently. One item might spend hours in a heavily automated grinding department, while another speeds right through it but spends days in manual assembly. Departmental rates ensure total precision.
Which brings us to Section 4, dealing with the differences.
Here's the plot twist. Because we're using budgeted, estimated rates to assign costs to products all year, the actual bills at the end of the year will almost certainly be different. This creates a discrepancy. If the actual costs end up exceeding the overheads we absorbed into our products, we are underabsorbed. Basically, we didn't charge enough. Conversely, if the overheads we absorbed exceed the actual final bills, we are overabsorbed.
So how do we clean up this financial discrepancy? You've got three options. You could go back and adjust the cost of every single unit produced, but honestly, that's historical data, useless for future management. You could carry it forward to future periods, but that distorts your future performance. So the cleanest, absolute best option? The third one. Treat it as a period cost and write the discrepancy off directly to the profit and loss account. It keeps your future data beautifully clean and accurate.
And finally, Section 5, Activity-Based Costing.
Activity-based costing, or ABC, is a far more modern, precise approach. Instead of just lumping all indirect costs together and absorbing them through a single arbitrary base like labor hours, ABC acts like the ultimate detective gadget. It focuses on tracing costs to the specific operational activities that actually cause them to incur.
To make ABC work, you have to find the cost driver. This is the fundamental trigger. A cost driver is any factor that causes a change in the cost of an activity. It asks the central investigative question: what specific action is literally making this bill go up?
Implementing activity-based costing involves two really distinct stages. Stage 1, instead of grouping overheads by department, you group them into cost pools based on activities. Stage 2, you determine the specific charge rate per cost driver.
To put that into perspective, let's say our activity cost pool is machine setup. The logical cost driver there is the number of setups. The more times you have to stop and set up the machine, the more that specific activity costs. Or if the pool is materials handling, the driver is the number of materials requisitions. ABC calculates exactly how much one single setup costs and charges products based on exactly how many setups they actually required. It's the ultimate tool for precision, for sure.
We have covered a lot of ground today, right? Moving from the basic mystery of shared costs through the 3 A's of allocation, apportionment, and absorption, all the way to modern activity-based costing. But I want to leave you with this provocative final thought. Look at your own business, or the businesses you analyze. Now that you know exactly how overheads hide in the shadows, are invisible costs secretly eating away at your profits? Mastering the tracking of overheads isn't just a dry accounting exercise. It is the absolute key to true profitability. Thank you so much for joining me on this explainer, and keep investigating those costs.